Max Kettner of HSBC is cautious on the road ahead. We are more concerned about longer-run Fed rate expectations, which have risen over the last month. This has not inflicted any pain on the S&P 500. That could change. Continued rises in rate expectations are more likely to prompt a pullback in risky assets and safe havens too. I'm pleased to say Max Kettner joins us now for more. Max, let's get straight into it. You're calling it the reverse Goldilocks trade. You've started to see rates reprice. Equities, though, haven't budged. Why not?
Yeah, good morning. Look, I guess the rise in rate expectations and the rise in long-end yields hasn't really been enough yet. I think this is quite similar to where we've been in summer last year, right, where equities were rising significantly as well in May, June, and July. And at some point, the rise in yields was just too much. And then suddenly, actually, interest rate volatility was picking up. So the reason I think why it's really not hurt multiples yet, and why we've been sort of not really particularly bothered with lower than expected earnings delivery outside of the Magnificent Seven has been number one, of course, because of this tremendous earnings delivery of the Magnificent Seven, but number two in particular from a broader market perspective, because interest rate volatility is still very, very benign. And as long as that continues, that's not going to hurt equities and other risk assets just yet.
So, Max, can you talk about how you're positioning at a time where there does seem to be this momentum? There is an increase in dividends. We saw Goldman Sachs come out this morning and increase their dividend expectation. You're seeing strength underpinning some of the ratcheting back of the rate expectations. So why wouldn't you be slightly bullish, even if you're concerned about go-go or row-row or whatever the new acronym is?
Yeah, look, I guess there can be too much of a good thing, and that's the concern that I have right now. Go back to where we were in the summer last year, right? Go back where consensus actually expected 0% GDP growth, and it ended up being 5%, right? Where earnings expectations were nowhere near what the actual earnings delivery ended up being, right? I think we started Q3 with sort of $54 on the S&P earnings, and it ended up being more than 58. So at the face of it, you should have bought equities. You should have been really, really bullish. But the problem, of course, was that a little bit of an uptick in inflation back then was already enough to inflict a bit more interest rate volatility and to send a bit of pain across the asset classes. Now, look, I'm not advocating for like the next 6 to 12 months things to be absolutely dire. No, but I do think with particularly also systematic investors, the likes of CTAs, risk parity strategies, volatility target strategies, all of those really running quite elevated equity exposure already that were a bit ripe for a pullback, and you want to buy into that pullback thing. But for now, right, it's really hiding out in shorter duration stuff, short duration investment grade credit, in things like low beta rates, right? So out of the higher beta stuff like gilts, like BTPs. Within equities, it's the short duration, the cyclical markets, actually. Things like Japan, things like Latin America. And we do still, given that positioning is